So now it's time to turn to the substance of our program. Leslie Preston will now join us for the annual economic overview. Leslie is a senior economist with TD Economics and has over 12 years' experience as an economist. In her current role as senior economist, Leslie works on macroeconomic forecasts and current analysis in the U.S. economy. We're not only pleased, but very fortunate to have her with us today. Leslie, will you join me?
Good morning, everyone. It's a great pleasure to be back here in Maine to talk to you for about the next half hour about where we see the global and U.S. economy headed over the next couple of years. It's also a great experience to come back to the same event for a second year because it presents an opportunity to look back at what I told you last year and to see, how much of that we at TD got right, what we got wrong, and it's a bit of a humbling experience. So come to you a little bit humbled on that score. Now, I know I did this a little bit last year as well. Sorry, let me just flip to my... Sorry, am I in the right... I feel like I'm flipping through someone else's slides here. Anyway, if we could go back. Okay, anyway, if we could cue up the beginning of the presentation, I'm not sure. All right, thank you so much. So I'm going to tell you a little bit, sort of a bit of a report card for us here at TD Economics about how we did from last year. So starting with the good news, last year I stood up here and told you that we did expect the U.S. economy to slow from around a 3% pace in 2018 to slightly better than 2% in 2019. And we actually got that one pretty much bang on. The challenge is that there are a lot of shifting undercurrents there, and we didn't get the details right, and I'll get into why that was. I also talked a lot last year about event risks in 2019. I talked about the fact that at that time, China and the US were in a ceasefire on their trade war and the tariff tit for tat that's been going on for a couple of years now. And of course, over the course of the year, that ceasefire didn't hold. The US ratcheted up pressure and tariffs on China. And of course, we just had another phase one deal signed yesterday, but that was a big weight on the global economy in 2019. It hit business confidence hard, and it hurt economic growth. So, that event risk was a big deal. On Brexit, that weight had been weighing on growth in the UK and still is, but we do see a clear way forward on that now that Boris Johnson has passed his Brexit withdrawal agreement, so the UK has a path ahead of it to leave the EU. I also talked about potential fiscal risks stemming from Washington, and that's actually a risk that didn't end up planning out. We may have other political risks going on today, but as far as the debt ceiling or Congress passing a budget deal, both of those were dealt with. Congress suspended the debt ceiling, and Congress passed another 2-year spending deal. So that really took those fiscal risks off the table through the middle of the year. But the biggest thing we at TD Economics got wrong was global growth. And that brings me to my first chart. Sorry, this is, I'm reviewing last year's deck, actually. Anyway, if we could bring up the 2020 deck, but we are seeing, basically, the chart I want to show you shows that global growth was 3.4% when I came and presented last year. And now we don't have growth for the year as a whole yet, but it's tracking 2.8%. So we did see expectations for global growth ratcheted down noticeably as the year went on. And this is partially, there's a variety of reasons for that, and I'll get into that a little bit more further into the presentation. But a lot of it came from weakness in Europe and Asia, and that was where the unexpected weakness came. As I said, we did expect the US economy to slow from its very healthy 3% pace in 2018 to closer to 2% this year, and that indeed occurred. And the 2.8% for 2019 is actually the slowest pace we've seen for the global economy in 10 years. So it was a dramatic slowdown we saw in 2019. And as a result, central banks around the world did respond to that. The U.S. Federal Reserve responded by, when I stood here last year, we still expected the Fed to raise rates twice in 2019 if economic growth continued to be strong. Now, as it turned out, with the weakness in global growth, the Fed, did what they're supposed to do. They pivoted from their stance of hiking rates to easing rates 3 times through the summer months. The European Central Bank also acted to cut rates and to stimulate their economy, which was also struggling under the global slowdown. So fortunately, we think that provided, enough of a boost that the global economy and the US economy didn't slip into recession, and we don't have a recession in our forecast over the next couple of years. So looking ahead to 2020, okay, maybe I'll just flip back to, won't distract you with this slide. Maybe, yeah, sorry about that. Okay, so where was I? Just getting back to looking ahead to 2020. So I mentioned the 2.8% growth in 2019 was the lowest in 10 years. We are expecting only a modest improvement this year on a global level to 3% growth, and that has a lot to do with continued weakness in the European economy and in Japan. For the US, we do expect the US to continue to grow at around the 2% level. So, not slowing too dramatically from here. We think the US consumer has a lot of momentum, but that globally the pickup will be modest, led by a lot of emerging market economies who were really struggling in 2019, and we do expect their growth to pick up heading into this year. But one of the main things that happened as global growth expectations got ratcheted down throughout the course of 2019 was that long-term bond yields fell dramatically. Financial markets were ratcheting back growth expectations, expecting central banks to start cutting rates. And what this did, starting in the spring, was it inverted the yield curve. Now, I realize I may be starting to see people's eyes glaze over a little bit, but basically all that means is that the yield on a longer-term government bond for 10 years fell below the 3-month, and markets were basically signaling that they expect there to be a recession. And that was what the financial market was telling us. But thankfully, with 3 cuts by the Fed, the yield curve is now no longer inverted. So the probability of recession by these kind of financial market models, which was at its highest over the summer months, has fallen back down. Now, we had always lent against these indicators, which were suggesting a higher probability of recession over the next couple of years, because the economic data wasn't necessarily there yet. And we calculate a leading economic indicator at TD, which is a suite of variables that track or where the economy is headed. Things like the ISM Manufacturing Index, housing starts, retail sales. And while that line, if I were to show it to you, has come down in 2019, we grade it as flashing yellow or flashing red. And once it starts flashing red, we do think we're on the precipice of a recession. And right now it's at yellow, which is consistent with growth in the neighborhood of 1% to 2%. So a growth slowdown, certainly, that's what we've seen in the economic data, but we don't see the factors necessary or the conditions necessary to trigger a recession in the US in the coming quarters. But certainly growth has slowed, and that's what our leading economic indicator tells us. So in the wake of the Fed pivoting and cutting rates, that really shored up market confidence quite a bit. And bond yields fell to their lowest level around August, and they have picked up since then. There are my slides. This is the PDF document. So you're going to see 2 slides per screen. So just at the bottom half of the screen there, that's the leading economic index. I'm just trying to see how big you guys see it. Yeah, it's pretty small. But it's deteriorated, but we're not in the red yet. And just the top slide is the point I was getting to now, which is bond yields have come up a bit from their lows, and we do expect them to go a little bit higher over the next year, but not to reattain the level they were in December 2018. And that's why we call that chart higher bond yields, but not high bond yields. And of course, this has implication for various market rates throughout the economy, borrowing rates, et cetera, that we don't expect a return to higher borrowing rates or high borrowing rates anytime soon. But of course, in the bottom chart, what we're showing there is really the sore spot in the economy right now is the manufacturing sector. Now, that's the case globally. Manufacturing really is in a slump. You could call it a manufacturing recession. And by some measures globally, we've seen the worsening stabilize. Unfortunately, in the US, the latest reading on the ISM Manufacturing Sentiment Indicator, which is a closely watched sentiment indicator, actually dipped down a bit further in December. So the sector in the US continues to be in contraction. However, typically, we do see these downturns in manufacturing outside of recessions. The manufacturing sector is more cyclical than the US economy as a whole. US economy has become increasingly weighted towards services, and we don't see necessarily that the slowdown in manufacturing has permeated out into the services sector. The services sector has slowed, and that's the dark dotted line, if you can see it in that chart, that it has weakened, but services remain in expansion. Now, fortunately, against this backdrop of weakness in manufacturing, the consumer side of the economy has held up a lot better. Labor markets in most advanced economies are doing quite well. Here in the US and over in Europe, unemployment is low, and the consumer is in a pretty good place. So indicators like retail sales have held up a lot better than the manufacturing indicators, and that's what those charts on the top show is really the divergence between continued growth in things like retail sales and slower growth or contraction within manufacturing. So fortunately, demand from the consumer has remained resilient. We do expect that to continue, particularly in the United States over the next year. However, we don't necessarily see a big pickup yet for manufacturing, partially due to the fact, as I mentioned, our global growth forecast is only for a modest acceleration from 2.8 to 3%. Now, the bottom chart is showing our outlook for the US economy as a whole. In 2019, it's still an estimate. We don't have data for the fourth quarter yet, but we're on track for growth of around 2.2% on a Q4 over Q4 basis. And that was about what we were expecting a year ago. The difference is that that gray area collapsed. That's business investment. And the heightened uncertainty due to the trade war and slower growth around the global economy really hit business confidence over the past year, and investment shrunk to basically nothing. In fact, it's contracted in the most recent 2 quarters. The flip side of that is lower rates from the Fed, lower borrowing rates that filtered through from bond yields, provided an added boost to the US consumer. And that's that TD green area, that consumer spending growth really held up well. We would have expected it to slow a bit more, but lower rates really gave a boost to consumers over the past year. And that's the message in the next chart. Basically, we're showing the bar shows the change in the 30-year mortgage rate in the United States, and the yellow dot shows the change in existing home sales. And you see that in 2018, we actually had quite a run-up in mortgage rates, and it hit single-family home sales. And in 2019, so far in the year that we have data for, this chart was done a little while ago, the drop in mortgage rates did trigger at the national level a pickup in existing home sales. So all that to say, we economists were a bit reassured. Monetary policy still has an impact. The Fed lowers rates. We do see consumers respond by purchasing homes, and also in the bottom chart there, increasing discretionary spending. Spending on particular goods that economists typically think of as interest sensitive. So in that chart, the lime green, that's recreational goods and vehicles. It's televisions, ATVs, boats, all these sorts of bigger ticket purchases that consumers, you can see these purchases slowed in 2018 and through the quarters of 2019 picked up. Residential investment, which had been contracting for a few quarters. Now that's not just existing home sales, that's also spending on new construction, renovations, anything related to investment in residences is counted there, and that area had been weak. That's picked up in recent quarters in response to lower interest rates. And finally, again, furnishings and household equipment, big ticket interest-sensitive items, very tied to the housing market, as I'm sure I don't have to tell people in this room. Typically when somebody buys a house, there are a lot of related purchases that are knock-on effects of that purchase, and we've seen those pick up right in line with the housing market. So consumer has responded to lower rates. Now, just to go a little bit into more depth on the health of the U.S. consumer, we now have all the job market data for 2019, and the U.S. economy is now on its longest streak of job creation ever. Of course, we need to consider the hole the economy was coming out of in terms of the financial crisis and Great Recession and the number of jobs lost. But we're now up to 115 months of job gains, which even relative to the 1990s, which was a period of very strong economic growth, is pretty impressive. And this is a big positive fundamental for the US consumer as we start 2020. And in fact, we at TD think that there's room to continue to create jobs over the next year or so, even though labor markets, according to the unemployment rate, seem quite tight. And this is a puzzle that a lot of economists have been talking about in recent years, which is the fact that wage growth, which has picked up, and in fact, I just put out a little summary of the 2019 labor market in the US, and even though wage growth is not where it was, say relative to the late 90s or immediately prior to the last recession, wage growth is the highest we've seen since then, and it did pick up in 2019. But one of the challenges that we think is that even though the unemployment rate right now in the US is close to a 50-year low, there are a lot of people still in the country who have left the labor market. And economists like to look at something called the labor force participation rate, which is the share of the population who is either working or says they're unemployed. And these measures actually, for many groups, remain depressed relative to history. Now, it's been quite impressive since 2015, which is when the labor market really started to turn around, that those participation rates have been rising. And I don't know if you get this chart package in your handouts, but that bottom chart separates men and women out. And on the right-hand side, for women, you can see particularly young women aged 25 to 34, participation rates are at an all-time high. This generation of young women is working at a much greater share than previous generations, and there's been big improvements for most age groups of women. There have been improvements for men as well, but this is where we see room for continued improvement, and that the US economy can continue to grow and put a lot of these people back to work, particularly when you look at males aged 25 to 34. That's that lime green line on the left-hand side of that chart. There is a subtle improvement since 2015, but still relatively depressed to where it was in the late 1990s. And you see this in comments. The Federal Reserve is increasingly talking about this. Jerome Powell, the Fed chair, is speaking about this at events. The Fed is trying increasingly to go out in the regions and talk to businesses on the ground, talk to people on the ground to find out how the economy is doing. And they're really starting to hear this, that 10 years into the economic expansion, the labor market has gotten hot enough that employers are having to reach out to groups or neighborhoods that might be more discouraged and have lower participation rates. And that's really been a benefit of the length of this recovery, that it's starting to draw in more people who had been marginalized from the labor force. And that's good news for the economy as a whole, good news for society, frankly. And we do think that there's room to make improvements there. Now, bringing it back here to the local economy here in Maine, Maine's unemployment rate actually over 2019 dipped below its previous historical low of 3.2%. Currently, in the latest data I've seen, is at it was 3.2% was the previous low. It's now at 2.8%. That's an incredibly low unemployment rate here in the state of Maine. Now, despite tight conditions, job growth has managed to hold up. You think you're running out of people to find jobs for. But here in Maine, it has kept pace with job growth across New England. But slow growth in the labor force does suggest pressures will mount. Now, one of the good news stories here is fortunately, oh, sorry, I forgot I had 2 slides on this page. The bottom slide shows that Maine has managed to attract a lot of in-migration. And those bright green bars show that your in-migration here in Maine has been incredibly strong. This is both international and domestic for the past 4 years, more than offsetting what would otherwise be a natural decline in population. So when you add up, a tight labor market, decent wage gains, and very strong in-migration, you've had quite a pickup in average home prices here in Maine over the past year, particularly relative to the U.S. as a whole, where the upturn in the national aggregate has been a bit slower. We do expect Maine, for 2019 as a whole, the average Maine house price is rising about 6% year on year. We do expect that to slow over the course of this year to around 3%. However, that's basically as the boost from the drop in mortgage rates starts to fall out of the equation. Now, fortunately, building permits have been up strongly here in Maine, particularly in multifamily, pointing to a bit more relief in terms of supply coming on the market. So overall, our outlook for the residential market is positive, but maintaining it will be reliant on Maine continuing to attract newcomers to the state to keep that population rate growing. Now, at this point, I think I did want to leave some time for questions at the end. So just to sum up, 2019 overall for the global economy certainly did not pan out as we were expecting. Global growth slowed much more dramatically. Growth held up a lot better in the United States, thanks to lower interest rates from the Fed, which boosted the consumer and offset the weakness in business investment, which was exactly what the Fed was hoping they would do. We also saw Washington actually agree on a new budget deal, which removed a risk off the table. Right now, I'll just say a few words. Actually, I didn't mention too much on the Phase 1 deal that the U.S. has reached with China. This is important, and mainly because it hopefully has lifted a cloud to a certain extent, the cloud of uncertainty that's been over a lot of U.S. businesses on what is going to happen next. But I don't think it's as much of a boost as the president may be hoping, because the reality is we've been down this road before. It didn't lift all tariffs off of Chinese imports, so those are still there weighing. And frankly, he's opened up a couple of new fronts in terms of investigations with Europe and potential tariffs there. So I don't think the administration has necessarily changed its stripes on its seeming preference to implement tariffs. So I think there is still that background uncertainty on trade, but it certainly is less acute than it would have been without this deal. And it certainly has buoyed financial markets and the stock market, which is positive for the U.S. economy. But overall, for 2020, we are expecting slightly better than 2% growth in the U.S., and for the consumer really to be the main story, that the consumer is expected to be the biggest driver of growth over the next year or so. So with that, I would like to open the floor up to questions. I know it's a big room, so hopefully someone is brave enough to to pose a question. Sir, right in front there.
Thank you, Sally. So the question was the in-migration. I have a question about that, and if you have any data that shows where that comes from, whether it's sort of people coming home or whether it's people finding Maine as a new, hotbed of place to come, and where they might be coming from.
Yeah, I wish I had more detail. We do publish a state economic forecast, and my colleague who does the more deep dive on New England and the regional economy, I was talking to him before I came, and he did say what he can say it's mostly domestic in migration, so it's not coming from international. The challenge with that is, which I pushed him on, is that if someone, if there were immigrants coming who, initially landed in New York or Florida, and then ultimately move to Maine, they may really be an international migrant in that they've only been in the US under a couple of years, but they would show up in the statistics as a domestic migrant to Maine. The challenge with a lot of economic data is we may get that detail, but it won't be for a few years. It's typically a trade-off between data being recent and how much detail you get. So I can say it's mostly domestic with the caveat that, maybe not ultimately domestic, but I think that detail will come out. And, we do have a census this year in the United States, so I think we'll get a lot more detail at the state level of where newcomers have been coming from. Lady in the...
Hi, I have a question.
Oh.
Given the tax cut and the spending increases, I read an article that said our deficit's up 50% over the last 3 years. Does that matter? Will it matter? When will it matter?
That's an excellent question, and it's one we economists struggle with. In fact, I think it was early last year I actually wrote a paper on that, which shows that, the U.S. budget deficit has expanded the most in recent years than it's ever expanded during an economic expansion. Typically, deficits rise in recession when tax receipts come down due to, job losses and losses at the business level hitting tax receipts. So yes, the policies of increased spending and tax cuts have blown a major hole in the U.S. budget. And when ultimately, the U.S. economy does have a recession, that deficit is likely to fall to the same levels seen in the global financial crisis. The advantage the United States has that other countries don't have is that the U.S. is seemingly able to issue treasuries at any amount, and the market will buy them at a relatively low interest rate. So, and it's difficult to see what would take for that to change. A smaller country like Canada, for example, if Canada had bigger and bigger deficits, markets would start to price in a risk on their government bonds, treat Canada more like Greece or Italy and demand a higher return to hold that. But that doesn't seem to be the case for the United States. So, the U.S. does, isn't paying a penalty, at least in terms of the interest rate it has to pay on its debt. The challenge is, of course, the more and more debt the U.S. has, even at a low interest rate, it crowds out other spending. Spending the federal government could be doing on other priorities, Medicare, Medicaid, whatever it wants to spend money on. It's having to pay an ever greater share of its budget on interest payments on debt. In fact, in the latest Congressional Budget Office outlook, that is one of the biggest growing, not in absolute terms, but in terms of growth rate, shares of the budget is spending on debt. So, it's an open question, as you say, at what point would, really international financial markets would have to stop buying treasuries, you'd see treasury yields spike, and politicians in Washington would finally decide, we can't just keep issuing debt, but so far there really hasn't been that discipline imposed.
Your answer may have just addressed this in part, but how do you assess the lasting impact of 2017 tax reform?
I think the jury's going to be out for a few years on that for more academic studies. You did see a pickup in equipment spending in the last quarter of 2017 because in fact that the full expensing, the ability to completely write off expenditures on equipment was retroactive to the fourth quarter. You saw a boost. It seemed to peter out pretty quickly, frankly, because of the administration on the one hand gave businesses this big boost with the corporate tax cut, and then they came in and imposed tariffs on everything and really hit confidence. And I feel like that did a lot of damage to the boost you were getting. So certainly there has been an economic boost. I think it proved a bit shorter lived than most people were expecting. And like a lot of analysts said in advance, it certainly wasn't enough to pay for the tax cuts. But I think it will take time in terms of one of the arguments for the cut in the corporate tax rate was international competitiveness relative to other countries. And I think it's going to take a bit more time and study to see what that tax cut did in terms of U.S. competitiveness on the global scale, and perhaps providing an incentive or lowering the incentive for corporations to shift profits abroad. There was a lot of creative accounting that goes on in that sphere. So I think it's going to take some time on that score.
Any other questions for Leslie? No? Okay. Leslie, thank you very much.
My pleasure.